Miningscout auf der Edelmetallmesse in München. Jetzt freuen wir uns, Chris Berry als Gast begrüßen zu dürfen. Chris, it's a pleasure to have you here at the Miningscout booth.
Thank you, it's great to be back.
So, first of all, the sentiment is quite bad. Gold price dropped, silver price dropped, iron ore prices dropped. What is your opinion on the current market situation?
Well, you know, I think from the mining equities perspective, which is one of the reasons that we're here, it's quite bleak. I don't think there's any way to sort of deny that. You know, when you flip on the TV every morning and you watch CNBC or you read the newspaper and you see gold continuing to fall and oil continuing to fall, it does a lot to the investor psyche and sentiment. And I think one of the important things to remember at this stage of the cycle is that you cannot view all commodities, whether or not it's all metals or all soft commodities, the same way. Just because oil has fallen from $115 a barrel in June to $78 a barrel right now, or just because gold is currently at $1,145 an ounce, that doesn't mean that there's not a compelling case for other commodities, like for example lithium. I'm very bullish on lithium right now, or another one would be cobalt. So if a lot of the people that I'm talking to, both on the retail side and the institutional side, this is the kind of thing that I'm saying, because I think you need to be patient, you need to be careful, but generally speaking, you can't view all commodities the same way right now.
But don't you think that shareholders might have burned their hands on gold and silver and try to avoid other companies as well, regardless of their commodity?
Yeah, absolutely. I think you're probably being polite by saying they burned their hands. They probably burned a lot more than that. Guilty as charged in that respect. And so, but again, I think that just means you want to be very careful about what you're looking for. Again, whether or not it's gold or silver, or again, I keep coming back to lithium, it could be anything. I think the keys right now, if you want to look at mining equities, you need to think of two things. Number one, you have to focus on the lowest cost producer. That is the absolute most important thing that I'm focused on right now. And secondly, it's all about sustainability. So from a mining company perspective, I want to see a very strong balance sheet with no debt and as much cash as possible.
So do you have any countries you prefer to invest in?
Countries? Well, that's an interesting question. I mean, I am an American, and again, if we're talking about gold and silver, I think you have to look closely at the United States, in particular the state of Nevada. This is a part of the world that has a mining culture or a mining history embedded in it. So, you have the rule of law, and it's very familiar to a lot of people, both investors and mining companies, and there's been a long, strong history of mining activity in that state. So that's one part of the world that I'm particularly interested in. If we're talking about some of the other commodities, again, I keep coming back to lithium. My level of risk, or my willingness to take more risk, is greater with respect to lithium, just because, yes, you can find it in the United States, you can find lithium being mined in Nevada, but I think you also want to look at other countries, other parts of the world, South America, Chile, Argentina in particular, which comprise two of the three countries that comprise the lithium triangle. With respect to what I call the electrification of society, the adoption of electric vehicles, energy storage. If these projections that we're starting to see for electric vehicle adoption are generally true, and I think they are, you're going to need more lithium in the future, and so you need to be thinking about where that's going to come from, and South America right now is probably the most popular place in the world for lithium production.
Okay, but for lithium production you need the exploration going on, and you need to do the financing first. So what do you think will happen if commodity prices stay low for a longer period of time, and companies may face serious harm during their dilutional or financing phases? Yeah,
well, you'll see a lot of companies vanish, and that's just the nature of the business. I mean, whether or not it's the Toronto Venture Exchange or what have you, these companies exist basically at the pleasure, if you will, of the financial markets, because they have to continually go back and finance. I'm surprised that the junior exchanges haven't consolidated faster. I think the sooner that happens, the better for all of us. It'll be better for investors, and it'll be better for the companies, because a lot of them will, quite frankly, be put out of their misery. Now, that said, exploration is a crucial part of the whole value chain. It's clearly out of favor right now, and I just think you need to start to see more tightness in supply and demand of a number of commodities for the exploration appetite to really come back, but it's just not there right now.
Do you think it will only happen to juniors to fail in this market, or do you think that even mid-tiers or even majors might fail?
Absolutely. I mean, you know, you could see a major. Again, it depends on the commodity, but maybe a major who's over-levered, has too much debt on their balance sheet. If gold prices continue to fall, you know, the potential for a bankruptcy isn't out of the question, and that would be a major minor, and that would be a shock to the system. I'm not predicting that, but generally speaking, when you look at a number of the major producers of a host of commodities, they're over-levered. They have too much debt on their books, and they have too many properties and projects that aren't economic at current prices. So they're in an asset shedding mode, if you will. They're getting rid of everything, and they're trying to de-lever their balance sheets. And it takes time, and it's painful. And so it won't just be the junior space, I think, that continues to feel this pain. It's all about your cost of production, and that's why I mentioned before, finding the lowest cost producers regardless of where you are in the value chain, explorer, developer, or producer. You have to be able to exist in, at least theoretically, a much lower commodity price environment, whether or not it's gold or anything else.
So you do think that it's time for going out to shop for the majors to buy some very well-established mid-tier producers, for example, that have their margins?
That would make sense, but you know, we talked earlier about shareholders. Shareholders have been hurt badly, regardless of whether or not you're talking about major producers or explorers. And my gut feel, my sentiment is that investors don't want the majors to go out and be in acquisition mode. They want these major mining producing companies to focus on organic growth and to focus on getting their balance sheets in order, and that means reducing debt, reducing leverage, and focusing on organic growth. So M&A will always be a factor in the mining space, but I don't really expect it to pick up at any point in time soon.
So acquisitions might not pick up, but what do you think about commodity prices? Is there a chance to go up again, or do you see the big shake coming?
I think there's a chance to go up again. Again, I'll come back to what I said earlier. I think it depends on the commodity in question. You know, I think the case for iron ore in particular is extremely bearish. You're looking at a commodity that's in excess supply, and demand, led of course by China, has fallen. So you're seeing sort of twin headwinds there. I think that, you know, looking at each commodity individually makes a lot of sense. Again, I'll come back to lithium. This is a commodity whose demand is growing at about 8% per year, roughly, and there is slight excess supply based on my research. But again, 8% demand is going to overtake the excess supply within the next couple of years. I think one of the other keys to look for with respect to companies, aside from low cost of production, is demand, the demand side that's growing well above global GDP. Okay, so if we argue, and we can argue about the statistics, but let's assume that global GDP is growing at 3% per year. Lithium's growing at 8%. Cobalt is growing at 6 to 7%. Those are much more attractive commodities to me than ones that are either growing at global GDP, like for example copper. I've been hearing people telling me that copper is a contrarian play right now. Who would have thought that copper is contrarian? I mean, it's so integral to the global economy, but again, it's all about supply and demand, and we're just facing a glut of a whole host of commodities, both hard and soft, as sort of an aftermath, if you will, of the commodity super cycle. And you know, the emerging market growth that was there a couple of years ago, China at 10%, India at 8%, Russia at 6%, is gone. Not gone totally, it's cut in half, but it's greatly diminished. And so it's a real challenge to stay in this space right now, and that's why low cost production and growth and demand well above global GDP are really two important metrics to me.
Thank you very much for the interview. It was a pleasure having you here.
Thank you. Appreciate it.